And it's Thursday again. Right, this is not going to be an easy presentation, so you're going to have to damn well concentrate. We're going to start in Australia, and I'm going to read that Australian fourth quarter GDP rose by just 0.4%, which was well below forecast. And analysts expect just about the central bank to hold its benchmark interest rate at the current 4.25% next month. Yes, there are places in the world that have old-style central bank interest rates. 4.25 in Australia. Yes, they say maybe, but the central bank will be cutting rates relatively shortly because Australia's running into trouble. Household spending rose by only 0.5%, residential construction declined by 4%, and developments in China in particular will impact Australia, which suggests to me that the Australian economy will remain weak-ish. Analysts expect New Zealand, South Korea, Indonesia and Malaysia central banks to remain on hold this week. The higher oil price is threatening to increase inflation. Central banks around the world now having to know what to do with this new oil price semi-shock that is coming in. Right. Now, that was easy enough, but you've really got to concentrate here because this is about the Argentina central bank, which probably isn't your central bank, so you think you can ignore it. But this is the sort of interesting information that I bring you here on Over the Peak. So, concentrate. Buenos Aires. Argentina's central bank chief Mercedes Marco del Pont Wednesday said a government-backed bill to reform the monetary authority will make it possible to use international reserves to spur economic growth and fight inflation. In the great world that has been existing in history, there have been fights between banks, central banks and governments about who controls who, and sometimes whom controls whom. Central banks were created not only to maintain the stability of the currency, but also to finance the state, to help finance system in time of crisis and act as lender of last resort, she said in a televised presentation of the bill before 3 congressional committees. So this is Argentina, but there are 3 things in there. Stability of the country, act as a lender of last resort, but slipped into the middle is but to finance the state. Note, this is not just because this is wacky Argentina, this is because this is central banks and governments, and this tussle goes on forever. This exists everywhere. President Cristina Fernandez de Kirchner said the bill to Congress, saying the central bank, while independent, should work to sustain economic and job growth, in addition to its current mandate to preserve fiscal and monetary stability. In other words, she didn't say it, but what she says is it's its job to finance the state. Marco del Pont stressed that the reform will give the central bank more resources to battle inflation, blah blah, which according to the government was 9.7% year on year, far below the private estimates of 20 to 25%. The reform of the central bank, this is Marco del Pont speaking, will make it possible to attack the problem of inflation, making more credit available to companies to boost output, she said. So that's de Kirchner saying the reform to the central bank will make it possible to attack the problem of inflation. The central bank had all the tools it needed for that, but making credit available to companies to boost output. The government is telling the central bank to lend money to everybody and anybody, so the government looks better. Yeah? And that sort of dynamic is going on in all countries. United States of America, The Long Road to Central Bank Exits by Richard Barley, The Wall Street Journal. Central banking has become a global growth industry. But it isn't just the size of the balance sheets that have changed, so too have their composition. With rates close to zero, the US, UK, Japanese and European central banks have pumped cash into the financial system, but each has chosen a different method and will face different challenges when they try to shrink again. I don't think so. The growth in balance sheets has been startling. The combined assets of the four central banks will top $9 trillion by the end of March, compared with only $3.5 trillion 5 years ago. The European Central Bank's €3 trillion balance sheet is the biggest relative to the economy at 32% of nominal Eurozone GDP, followed by the Bank of Japan with 24%, the Bank of England with 21% and the Federal Reserve with 19%. The Bank of England's balance sheet has expanded fastest in the crisis, more than tripling to lots and lots of pounds. Wall Street Journal again, John Hillenrath, who is the direct Wall Street Journal man for the Fed. The Fed uses Hillenrath to get information out to the world. Federal Reserve officials are considering a new type of bond-buying program designed to subdue worries about future inflation if they decide to take new steps to boost the economy in the months ahead. I'll repeat that because you're probably going to sleep. Federal Reserve officials are considering a new type of bond-buying program designed to subdue worries about the future inflation that if they decide to take new steps to boost the economy in the months ahead. In other words, if they're going to do QE3, maybe, they're going to need something to calm people's fears. I won't read the second paragraph and can say in number 5, follow link number 5, Hillenrath and the Fed have put a video together for you so you can understand it. But I don't recommend watching it, but there it is. Financial Times helps out an awful lot more on this situation. Sterilised QE, Bernanke 1997. Stay the course, Bernanke 2012. I recommend reading the article because I can't read it all to you. Substantively, our results now this is Bernanke, isn't it? He's only written it, but we can Bernanke this. Substantively, our results suggest that an important part of the effect of oil price shocks on the economy result not from the change in oil prices per se, but from the resulting tightening of the monetary policy. You didn't understand that. What Bernanke is saying is that in the past he's seen, because he's an academic, oil price shocks come in which causes a spike in inflation, and the central bank goes, inflation, we can't do anything about, we can't, loosen money or anything because of inflation. But Bernanke says, but I know now, it's only a short-term oil price shock, and that shock will wear off, and it is madness to start tightening into an oil price shock, because the oil price shock will shake the economy, and the last thing the economy needs is the central bank starting to pull down on temporary inflation. And now you do understand that. It's all right, don't mention it. Later in the Financial Times article, we get very generous comments from them telling us more. Our best guess for what's happening inside Bernanke's head, ? Quantitative easing works. This is what's going on inside Bernanke's head. Quantitative easing works, and as for oil prices, they're caused by exogenous factors, and I can't do anything about them, and their impact will subdue over time. You understand now. I am not going to do or pursue anything that's even remotely tightening right now, especially while I don't know whether to trust the robust employment figures of late or the more sluggish growth data. But there is skepticism about how to proceed, including inside the FOMC. It's not just inflationistas out there. There are actually doves in, or hawks there would be, inside the FOMC saying, So, if I need to throw a sop to the hawks and moderates with chatter about sterilisation, then so be it. Maybe I'll even do some of it, but the net effect will unambiguously be expansionary. Okay? So, go back to the Hillenrath video if you haven't. See that he's going to do fluffy things, presentations of fluffy things, to make inflationistas marginally happier. He's going to do token gesture something, but the net result will be unambiguously expansionary. Plenty more money. Wall Street Journal again, Brian Blackstone in this case, flood of loans reflects rising risk at ECB. Frankfurt. The European Central Bank's balance sheet soared past $3 trillion mark last week after the ECB flooded banks with more than $500 billion in cheap loans, an indication of just how much risk the central bank has taken onto its books as it scrambles to limit the fallout from Europe's debt crisis. Eltro. Interesting on Eltro. You know, I've always called it Eltro. I obviously don't listen to them in the world, because it was only last week that they've started calling it Eltro, and it's semi-official now that you call it Eltro. Apparently up to then it was called LTRO. Funny, isn't it? Now they all call it Eltro, and it's got a special writing to it. It's a big L and then small RTRO. Weird people. Why couldn't they just go Eltro to start with? Follow the mystic. The ECB's balance sheet edges that of Japan's central bank as a share of its economy, while easily surpassing those of others such as the Fed and the Bank of England. We get a chart going with this, and that's the ECB's going up, but the information's on the right there. The ECB has moved. In 2007, their balance sheet was 17% of the gross domestic product of the Eurozone that it covers, and it's now just about doubled to 32%. Federal Reserve 2007 was 6, it's tripled to 19. Bank of England was 7, it's tripled to 21. Bank of Japan was already into it, as we know, was 22 and now is 30. I would consider that the 32 and 30 are more important than the tripling up to 19 and 21 respectively. Moving on. Capital markets, Financial Times, banks deposit record $821 billion at the ECB, so that's over $1 trillion. And this is these reserves of the banks. Now, this article, as all the other articles do, say that they can make loans with this and really should, and that'll save the economy and whatever. I'm now starting to be a bit not so sure on the why lend this money when you can print up your own. But let's say they do lend this money for a mortgage, a 20-year mortgage, 25-year mortgage, whatever it might be, at whatever rate. They've borrowed this money at 1% per year. They do a mortgage lend at 4 or 5%. They're in the money. But these are long-term loans from the European Bank. They're called long-term loans because banks don't normally get loans of this length. This is a 3-year length, enormously long for a central bank loan to a bank. But it has to be repaid after 3 years. So you've put all the money into lending to somebody else for 20 years, and that is going to have to be left out there. You're not going to sell that loan after 3 years, are you? So you have to pay the ECB back. This is what's tricky with the ECB Eltro as opposed to QE, which is an actual sale. The Eltro has to be paid back. It's 3 years away, but then $1 trillion worth in a couple of months will have to be paid back to the central bank. Or the central bank has to roll it over again at a certain figure. That certain figure will definitely be more, and I would be guessing it'll be between 1 and 2%, probably about 1.25%. In other words, I think the central bank has got itself into a position where people have got themselves into a position with banks that they are now hooked on low rates and they can't get off. In 3 years' time, the ECB will have to roll over that $1 trillion of loans to the euro banks at a very accommodative rate. And if they do it twice, unless there is an absolute blossoming in the economy, the world economy, they are going to have to do it again and again and again and again. Yeah. The Telegraph, UK, lending rates hit all-time highs. I'll just give you the headline here. Banks are squeezing households by record amounts with high interest rates on overdrafts, mortgages, credit cards, despite the Bank of England's base rate being at an all-time low, and these banks being mainly owned by the British taxpayer. The government and the central banks are saying to the banks, where you can now, start pushing out. Try and getting more and more interest on those loans that you're giving. Try and get yourself really going and making money again. But as I say, the people are in the same situation as the banks with the ECB. They are now pushed up to, they are getting used to the smaller interest rates that they were having, especially on mortgages, and will not be happy to be pushed out even by 0.25%, 0.5%, and it's going to really cause them damage. And again, this is a long-term thing that I have no clue how you get out of without breaking the system. It's blackmail, but the people that are doing the blackmailing don't even know that they're doing the blackmailing. But that's what it is. Right. Now, if that wasn't tricky enough, and I should have stopped there, I'm going to throw in Target 2. For the European people who know anything about what Target 2 is. There's a huge internet discussion going on about the importance of Target 2, because the German central bank, the Bundesbank, now is, on the balance sheet of all things, is gone down now 500 billion euro. The bottom line is, follow these next two links. The bottom line is that it really doesn't matter at all as long as the euro area stays together. It really doesn't matter as long as the euro stays together. And this is the important part. Is the euro going to stay together? Because if it doesn't, that great swatches of that 500 billion euro will be lost by the Bundesbank. But if the euro stays together, it's a perfectly all right system. What we have is real-time balancing or not real-time balancing. Target is real-time, from the word target, but it's real-time balancing for the banks. It's not real-time balancing for the central banks of the countries. That just stays out there unbalanced, and there's just a natural idea that eventually it'll balance itself up. But obviously with the problems in Europe at the moment, it will never balance itself up. And it's quite likely that the Bundesbank, you can't even call it a negative, but the number is, let's call it negative 500 billion at the moment, is only likely to increase. Right. In the United States of America, the local, what do they call them, regional central banks balance out at the end of each month. Not just the banks, but the central banks, the regional central banks of the Federal Reserve system balance out at the end of every month. But the euro just wasn't set up that way because, well, it'll be all right. That's what they decided. And if you have followed what I've been saying so far and have been interested, which will be very few of you, if you follow the Bruegel link here, Target 2 of the ECB versus the Inter-District Settlement Account of the Federal Reserve, shows you the difference or similarities between the two systems. But the bottom line is, as long as the euro stays together, it doesn't matter what's on the central bank's target books. But obviously in Germany they're thinking that it's less and less likely that the Eurozone will stay together with the euro currency. So it's becoming, Professor Sin is becoming more right and more right, because things, if they do break apart, the Bundesbank will technically lose money. Should I have this one more thing? One more thing. There are certain countries, Germany being one of them, were used to running the Bundesbank. When the Bundesbank made profits, those profits were spread out into Germany, basically. Some other countries didn't do it that way. And Germany will not be able to do that now. They would be taking losses instead of getting the gains. That Target 2 thing is so very complicated. I don't recommend anybody going into it. But if you followed it this far, those two links are the best, because you've got in the Financial Times link, Izzy's had a go, Tracy's had a go, Neil C's had a go, Martin Wolf has had an epic go with all the links, and you could follow to all those. And here to add to the vexed mix is more on the subject from Greg Fuzzy at JP Morgan, and you can follow that as well. But I don't recommend it. But hopefully we've got a grokking idea of the dynamic tensions between government, central banks and the banking system. It's terribly tense, and people, mostly unwittingly, are pushing each other into blackmail positions. And basically I can't see any winners coming out of this, and certainly can't see any way that the central banks will ever be able to raise interest rates again. I know forever's a long time, but as long as, for a long time anyway. Hope you paid attention and stuck with it, and if you did, damn well done. Thanks. Bye.